What up, everyone? Welcome back to Financial Education and Business. We're going to be covering Oscar stock today. History. Recently, Oscar, Oscar has been taking off like crazy. The company. Let me see. Health. Oscar Health is specifically in the health industry, and they are very involved in the Oscar involved in the ACA, like the Affordable Cares Act, Obamacare. They provide health for employees. So Oscar Health operates as a healthcare technology company in the United States. The company offers health care plans to individuals, families, employees, and small group markets. It also provides Oscar Plus platform that powers uh, others throughout the healthcare system. Engagement and recommendation. So practically, they're in the healthcare industry. They kind of allow like employers to offer health plan to their employees that is really useful for the employees and cheap for the employers. Often, if you work in a large institution, you'll notice that these companies kind of buy into these large healthcare providers, and think of like Aetna or something like that. And what they'll do is the your employer will pay this health company like a ton of money, and then you can go and get health from this company or health care group, market group that your company is willing to work with. But however, sometimes this can be expensive for the employer, and Oscar is trying to find a way to where if you're a large company or a small company, you have the option to be able to provide healthcare to your employees at a cheap level. What happens often is that like these large institutions, large healthcare providers, like if you're a company that has let's say 200 500 employees, you'll say, hey, United Health, we have 500 employees, we want them to do health with you guys. That will give United Health a whole bunch of new clients. But then the health provider might be willing to give your employer a discount on the health benefits for onboarding 500 200 clients. But the when you're a smaller employer, you'll find it really hard to provide cheaper healthcare for employees. What happens is these large institutions like United Healthcare, if you just go up to them and say, hey, we have 3 employees that we want to, let's say you own your own business, you have 2 3 maybe 5 10 employees, you want to provide health, and you go to United Health and you say, oh, hey, we have 20 employees, we want to onboard with you guys, and here's the plan that we would like to provide the employees. United Health might say, listen, you're only bringing 20 employees, you're going to pay this much money, versus they might give a discount for the large institutions, corporations that are onboarding 500 200 plus employees into the marketplace for their health. So what Oscar is doing is actually trying to say, hey, listen, these large institutions are expensive for large employers and smaller employers to offer their employees good and healthcare that is good and not too expensive for their employees. And they end up providing health. They end up providing like health plans for you as a company to provide to your employees at a cheap level. Doesn't matter if you bring in 2 3 4 5 employees or 100 employees that so Oscar is trying to do something like that, to where now if I am like an Uber driver, or if I am a full-time employee, or if I have my own business, I can actually use something like Oscar to get healthcare that is not really expensive, and that's healthcare that is actually affordable. So we've seen a whole bunch of crazy events happening, United Healthcare and the whole CEO, shooting and all that kind of stuff. And there's the best way to kind of solve this problem is give people the freedom to choose the healthcare that they want, and get away from these large corporations that are kind of gouging the middle market. And I believe that Oscar is sitting right in between, and it can end up being the platform that really helps a lot of these smaller companies and larger companies to just provide really good health solutions. So, individual coverage health reimbursement arrangement. So, employers use ACA compliant tax advantage fund to reimburse employees for individual coverage. So, practically, with what employees can do is, rather than paying the money to these large healthcare companies like United Health, employees can just say, "Hey, listen, you're my employee. I'm going to give you $5,000. You can go and choose. You can go and choose any type of health plan that you want. We're going to leave that up to you. We're not going to go find one on your behalf, and then you have to go sign up for this health company specifically." So when employers kind of sign up onto this like a healthcare marketplace, one of those is like Oscar, and Oscar can find all these different groups that are a little cheaper for the employees to actually have good health. So the employees can go and invest that money, or use that money to get the kind of healthcare that they want, and they can do their own research and let the employees decide, rather than the employer deciding on behalf of the employer, on behalf of the employees. So this saves a lot of money for the employer, because now if you have to have a healthcare department that kind of compares and contrasts, like, okay, what is the best benefit that we should use for our employees. Now, if you don't have to have like a healthcare department, and let's say you're 5,000 6,000 employees within your company, if you can just say, listen, we're not going to have a healthcare department in our business, all we're going to do is we're just going to send the money to the employees and let the employees decide the kind of health that they want. So this is the industry that Oscar kind of plays in, and I believe it's going to save money for both the employer, and it's going to give the freedom to the employee to kind of go and find the health care that they really want. So because of this, one of the things that right now Oscar is can see a pinch, or can lose a lot of the, I guess, the benefits that they have right now, is that the ACA, the Affordable Cares Act, obviously is very specific to certain people, demographics in the United States that make a certain amount of money. And so that means if the individuals are not making enough money, they can be part of the healthcare plan. But obviously, if you're above about 200% or 150% below the poverty line, then you can get the healthcare. Otherwise, you cannot get that healthcare. But so obviously this was created by Obama. The ACA is also called the Obamacare or Affordable Cares Act. Obama came up with this whole idea, but the thing is, Trump is in office now, and Trump does not like this. He's spoken negatively about this entire plan, and there's a chance that this plan can just disappear. And this, if the government decides that by December of this year, they are gonna just cut this off, cut the ACA care off and they don't want to use it anymore, I think Oscar as a company could see major headwinds. But if um, there's more like some kind of like, we're gonna, within 3 or 4 years, we're gonna slowly just end the ACA, the Affordable Cares Act, and then we're gonna replace it, with something else. I think then that would actually be a great benefit for Oscar. Um, but overall, that's kind of what I wanted to cover here. So as you can see, just overall, they're just a healthcare company. They want to be the marketplace for all of this, um, for employee healthcare benefits. Just sitting between, they want to sit between the employer and the employee, and just be able to provide healthcare um, in a very inexpensive manner. But however, right now there's just a lot of fear that if the ACA footprint goes away, Oscar is gonna see major impact. But like all the time, we notice that when when any bill, I think when any bill passes, that you think that the government is making these decisions on behalf of the people, what would be good for the people. But in reality, what happens is you have these large institutions, large companies that kind of mm, pay congressmen and congresswomen money to kind of push certain ideas within the bill, so that when the bill passes, these congressmen and congresswomen actually get a certain amount of money or backing from companies. So in this case, if Oscar is able to, kind of work with Congress and give certain people money to kind of push this to go through, and to actually not to actually keep the Affordable Cares Act well into 2028 or 2029, or keeps certain aspects that actually is going to continue to help Oscar do well fundamentally as a business, then the whole Affordable Cares Act problem that they are facing right now might not even be a problem in the long term. So right now, I mean, there was a couple of interviews on YouTube where the CEO is kind of just saying, we're practically that they're trying to push update certain parts of the bill, the big beautiful bill, so Oscar can actually be part of certain things can pass within that bill that's going to help Oscar in the long term, or as a company. So I mean, that's literally how the whole industry works. Is just large institutions. Large institutions kind of giving money to congressmen and congresswomen to kind of pass certain things. So when you look here, it's been insane a little bit. Oscar has been exploding recently, actually since last week. So as you can see, the companies actually over the long term, they have not been doing well. Like if we look at the year, no, let's look at the 3 year. Is it 5 year? So if you look at, since they went IPO up here at $31, they've dumped significantly going into 2023, 2021, and then obviously the entire COVID situation. And then as we come out of that, it looks like they're doing some kind of recovery. But recently, the company has been exploding very, very, very fast. Year to date, as you can see, out of nowhere, like over the last couple of weeks, this company has just been all over Twitter. People are talking about it, and the stock just has been going insane, like 16 to 17% every single day. Every single day the stock market opened. As you can see, we were sitting at $13, $14, $15, $16, $17, $18. As you quickly just shoot up all the way to $22 as of last Friday. 21 closing at $21 and and $21.22. So from stock performance perspective, recently the market Oscar has been doing well. As you can see, it bottomed here in 2023 to $2.15, and it has not stopped since then. It's just been taking off. It's just been taking off like crazy. This, even though the stock is doing well, the risk of the ACA, the Affordable Cares Act, expiring this year is still a big risk for the company. From like financials perspective, Oscar is actually doing very, very well. If you look here, so quickly to show you like how Oscar kind of makes money is, the way Oscar makes money is just the difference between how much the employee pays for the healthcare and then how much Oscar has to pay the people that actually execute the health care itself. So when that difference between the two is how that the premium is how they make the money. So as you can see, their premiums and annuity revenue, as you can see, it's just been growing year over year. I mean, you can't argue this. I mean, this is fantastic revenue. As you can see, the revenue since 2020 has just been expanding significantly. I mean, this is insane growth. I mean, look at what happened in 2020 and going into 2021 at 300% change, 100%, 40%, 50%, and then going, it looks like trailing 12 month at 54% total revenue growth here. So the company is growing very fast, and actually is growing the number of people that are actually onboarding significantly. My biggest fear here is, yes, revenue is doing well because they're onboarding new people, and those people are getting healthcare, paying the premiums. But my biggest worry now is the business that Oscar is in could get hurt. Meaning, recently that we've been seeing that Trump has been just deporting a lot of people, shutting down the wall, so nobody's coming across. Those are the people that are gonna be within that segment of healthcare, and are gonna actually use Oscar Health as a source. And so that's my biggest fear, is that if Trump continues to kind of deport people, Oscar Health might actually lose some of the clients that it already has, and maybe not, revenue might actually kind of take a hit because the number of individuals that are using Oscar as a way of doing the healthcare might go down. And then let's go look at their operating income. So operating income, total operating expense. So as you can see, their operating expense is growing significantly as well. So they went from $798 million to $2 billion, $4 billion, $6 billion, $9 billion. So that's growing. That's growing. I mean, when the more business you have, the more expense you're gonna have anyway. So it's not a problem. Once again, this company is still struggling to make be profitable. Meaning, do their regular business, pay everything out, and actually have money at the end of the day, and to go into net income, and then to be able to invest into other things. But these are the kind of companies that that are risky, but if they can start hitting operating income, it looks like they hit their the first operating income in 2024. The great thing about actually making money and not losing money every single year, the great thing about this is that when a company is actually able to make money, that money ends up getting reinvested and actually growing the business over and over and over and over again. So that is the great benefit of Oscar actually finally hitting this this operating income, and that's, I think, is going to be the it's going to be a great catalyst for the company in the long term, that they keep hitting this net this operating income. And then when they hit operating income, obviously, things quickly start multiplying. And it looks like an operating income perspective, trailing 12-month, they're already at $168 million. I mean, overall, you're seeing some kind of improvement here, right? So I mean, they were losing 400 million, 544, 589, 157, 57 operating income, and then now they're at 168 million. Not bad. I mean, this is just gonna help the company grow in the long term. They obviously have interest expense and everything like that. And then when we finally get into net income, we're going from a company that is losing money and finally hitting net income. And this is where the companies like this actually grow and end up catching the eyes of a lot of other institutions, and other institutions that are seeing, okay, this company is actually making net income, and we can actually buy the shares and invest in the stock. So from like an assets quick ratio perspective, total assets, total liabilities, it looks like, definitely getting much better here. They got 2.2 million, 1.8 million in assets versus liabilities. It looks like they have always had more assets than they do liabilities, which is always really good sign for a company, small companies especially, where they don't have net income. It's always operating income for them to continue to have not as much debt. Long-term debt, term debt, lease. I mean, looks like their long-term debt here has just kind of stayed consistent here. Short-term assets, total other receivable, property, plant, equipment, other current assets. So these are current assets, other current assets. So these are property, plant, equipment, other receivables, cash equivalents, total investments, liabilities, shareholder equity. So one thing about Oscars, they do issue just a little bit of amount of shares each year. I mean, this is not bad compared to like a lot of companies out there, but they are, however, or regardless, issuing shares, diluting a shareholder base out there. Net income, 25 million net income. Operating cash flow, it looks like the operating cash flow is getting better here. They got about $978 million from operating cash flow. I mean, this is obviously getting better. They were positive here, negative, positive, negative, positive, negative. It looks like it's going. This is not consistent, but looks like it's it's getting better. It's getting better. They got investing cash flow. I mean, cash flow from investments. Looks like this number here is going down. Investing cash flow, they're not doing. I mean, they really don't have that much money right now to be investing too much. So this obviously isn't going to be a lot. It looks like here they hit about a $1.3 billion in investments. I don't know what they did here, but it's a big number. Financing, cash flow, plant, equipment. This number also is looking quite low as well. Quick ratios, market cap growth, 60, 200, and then obviously currently it's down. Market cap growth, not really that important. Quick ratios are the best ones to see how. We obviously looked at the quick ratio. I mean, this company's quick ratio has been kind of going down, which, debt divided by equity, right here. This is always good, you know. So companies quick ratio is their quick ratio is cash short term investments plus accounts receivable divided by current liabilities. So current assets divided by current liabilities. Um, so this is actually all good. This is not bad at all. They have enough money, as we saw, to cover. This is the current quick ratio. Um, current assets divided by current liabilities. The current ratio is used to measure a company's short-term liquidity. So this isn't too bad. These are not too bad, but here is just a little bit scary. Um, they don't have as much current asset here. They got more liabilities, but as we're seeing that they're probably gonna be over one already here. They're gonna have more cash. You know, as the company makes more money, it's gonna be good anyways. So let's look at X. Let's just look at what's going on in the world of Oscar. There's definitely Oscar, a lot going on for Oscar. So what is X saying? So I'm buying this dip on Oscar. So it looks like, right now there's a Twitter is all about Oscar. I mean, everybody's talking about it, and then the volume, oh wow, the volume on Oscar is just kind of insane right now. Let's go like this. Let's go Oscar. Oscar. So this is exactly why I decided to take profit on Oscar. Yeah, I mean, so it looks like this guy's worry here is that the stock market is gonna open very negative. When HIMS broke out of the cup and handle, it ran nearly 300% higher. So interesting. So this guy's saying that when we had this on HIMS, the stock ended up shooting up almost 300%, and he's seeing that it's about the same thing here with Oscar. We're seeing a cup and handle, and then next thing you know, we're gonna see what about 300% gain to $84 a share. I mean, he's looking at this and he's saying by 2026 July, maybe 2027, he's saying it's probably an $80 stock if the technicals work out. So we're seeing the handle green. We're seeing the handle green. Maybe anything can happen, but interesting technical analysis there. So this individual, I really do appreciate all the detailed work he does here. He does his analysis and he kind of comes up with a fair value for the stock, current value, like as of right now, as of today. He's saying that the value should be that $39.47, but in reality it's trading at $21.22. So if you buy it now, it's probably going to go to about $40 a share. That is about an 86% upside that the company has, the stock has from here. Which, if he did his math right, if he did the right kind of discount rate and discount cash flow process, then maybe that does make sense. He said, "This is crazy. Who can explain to me why the market is disrespecting Oscar Healthcare so much? He said, even assuming a 0% growth and a heavy dilution, meaning issuing more shares, it's almost 100% upside, just fair intrinsic value. Assuming 15% CAGR for the forecasting period, it is undervalued by 360%. So he said, what the heck? So, I mean, it looks like if the company doesn't even grow any revenue growth and they continue to get the same revenue year over year, the company and they issue more shares. It looks like outstanding shares, and then they're issuing more shares, about 18%, 16%, 15% shares going into the future. The company still is undervalued by about 360%. So, I mean, this is I already like this. This is obviously a really good analysis of the company. Here we got Oscar closing expectations. Oscar Health. I'm reminded of Charlie Munger quote about solving complex problems. Invert, always invert. This week, Oscar and our CEO were featured in this Associated Press today about the growing momentum behind individual care health reimbursement accounts. I think that's what it is. As the piece notes, is especially powerful for small companies that haven't offered cover in the past. The adoption trends are another strong signal for ICHRA. ICHRA is meeting the moment for both employees and employers. I mean, obviously, this is pretty cool. Normally, U.S. employers offer health coverage. Will have one or two insurance options for workers through what's known as the group plan. Right now, I do work at a large corporation, and I do only get like one or two options to choose from. It's not even that big of an option. So the market is small. The employers then pick up most of the premium or cost of the coverage. The ICHRAs are different. Employers contribute to health insurance coverage, but the workers then pick their own insurance plan. The employer that uses ICHRA hires outside firm to help people make their coverage decision. The ICHRA were created during President Donald Trump's first administration, and this is why the ACA program could go away and the ICHRA program could really take off. And it's not going to have Obama's name anymore. I think Trump would like that as well. Enrollment standards started slowly but has swollen in recent years. What's big deal about ICHRA? They gave business owners a predictable cost, and they save companies from having to make coverage decisions for employees, and this saves the company a lot of money, and they don't have to have a team to go and look around to find the best coverage for their employees. Small businesses in particular can be vulnerable to annual insurance cost spikes, especially if some employees have expensive medical conditions, but ICHRA approach keeps the employer costs more predictable. Company-based Yuan's company basis is cost contribution, employees' age, and how many people are covered under the plan. That means it may contribute anywhere from $400 to more than $2,000 monthly to an employee coverage. So for companies, definitely not a predictable cost, because it could be $400 or it could be $2,000. The cool part about Oscar is they actually are very focused on giving healthcare to younger age group, and I think this is a great benefit for them because the younger individuals are not going to be going to the health to get health like every single month, or they're not going to go through something crazy every single day, like with the like an older individual. So the ICHRA lets people pick from among dozens of options in an individual insurance market instead of just taking whatever the company offers. That may give people a chance to find coverage more tailored to their needs. Some insurers, for instance, offer plans designed for people with diabetes. So if you have diabetes, so this is pretty cool. So if you have diabetes and that's the kind of plan that you need, you can go to the marketplace and just say, oh, I actually want this type of insurance because I have this type of certain risk. Versus like if your company just says, you can either use this or this, then it might actually be a bad thing, because what you actually need, the actual health conditions that you have, might not be covered by either of the plans offered by the employer. So the ICHRA plan this could be huge. This I think this is going to be really big. But this is why I like a company like Oscar's kind of being that middleman and trying just collecting premiums. So here it says, and workers can keep the coverage if they leave, potentially for a longer period than they would be able to with traditional employee health insurance plan. They likely will have to pay for full premium, but keep the coverage also means they won't have to find new plan that covers the doctor. Interesting. What are the hard drawbacks employee? So health insurance plans on individual market tend to have narrow coverage. Yep. It may be challenging for patients to say, yep. People should shopping for their own insurance can find coverage choice in terms like deductibles or co-insurance overwhelming. When I did my insurance, it was very, very overwhelming to go through. What would I actually want to use? That makes the broker or technology platform setting up a company's ICHRA generally does this by asking about their medical needs or if they have any surgeries planned on their upcoming year. So the cool part about this ICHRA program, and if Oscar really is able to market themselves and get on board, get a lot of these large corporations to be on board, then this can benefit a company like Oscar, but they have to get themselves in front of like a lot of these large corporations and companies, so that the employees actually have the options to do this, and it's a win-win. The cool part about this program seems to be it's a win-win for both, for the employee and the employer. So will growth continue? So several things could cause more employers to offer ICHRA. As healthcare costs continue to climb, more companies may look to limit their exposure to it, to the hit. Some tax breaks and incentives that encourage the arrangement could widen up. The final version of the Republicans' tax plan currently under the consideration in the Senate. So if this passes, it's the big beautiful plan. More people also will be eligible for arrangements if extra government subsidies that help buy coverage on the Affordable Cares Act individual marketplace expires this year. Yep. We do a lot more now. Like in the past, and this is what I'm saying, like in the past, the ACA program, like you didn't really have to file your taxes for the year. You didn't have to prove that you were an American citizen. It also covered insurance around like gender care. So if you wanna cut off certain parts, the ACA program let you. But now they're saying no. All these things are gonna go away, and it's gonna be way more stringent. And then, in the past, if you had with the ACA program, you actually didn't even have to re-sign for it. The health provider can just renew it automatically. But now, obviously, they're cracking down. And then the problem with the automatic renewal is that the company that the individual that has that insurance might not even know they have it, and they might end up going sign up somewhere else. Don't even know they got insurance at all. So now the rule is the employee has to actually go and say, yeah, I want to renew again, and actually click. Otherwise, it's like $5 charge or whatever. But like they're kind of like saying, listen, this is kind of a scam and we need to set ground rules. And I think it's going to be very important that it does happen. So it lets employers reimburse employees for individual insurance without the risk and cost of traditional growth plan. Oscar Q1 report shows that the ICHRA employment are growing growing about 15-20% annually, and 80% of the adoption were previously uninsured. This taps into 2.5 trillion US healthcare market that has been undervalued. Subsidy sunset. The expectation, the expiration of the ICHRA premium subsidy could pressure enrollment, but Oscar's employee partnership plus its 12 state reinsurance deals are buff. That's kind of cool. So they are 12 state reinsurance deals. So they are working with 12 plus states. Hold for 2 to 3 years. The ICHRA subsidy expiration is issue, but Oscar margin expansion is within the ICHRA program. So this isn't just another health insurance. Oscar AI plus combo is reducing the costs, expanding access, and building loyalty, all while Wall Street underestimates its potential. The math is clear. $3 billion in revenue today is $13 billion by 2028, right? Because that money will definitely from large employees and small employees. Kind of cool. So Oscar seems to, from all we are seeing, Oscar seems to be in the, on the right track here. That's why we're seeing the stock just kind of exploding in the recent days. And even if, right now their biggest risk is that program, their biggest risk right now is the ICHRA program, but if they can find a way to make the ICHRA program work, I think they have great potential over the long term. They're going to be able to make money here.